Hey guys, Derek Long here, Quest Trust Company. Thank you again for taking the time out of your Saturday to come get some great education in the real estate area and how to use your self-directed IRA to honestly build wealth, not just for you, but for your future, and your family members. So today we actually have a really neat topic. Before I dive into that, I just want to remind everyone right now that our Quest Expo is right around the corner. I think this is actually really important, really unique, just for you guys to understand what the expo is going to be bringing about. But really, remember, guys, we're bringing in up to 30 to 40 different speakers from across the U.S. that's teaching on different topics in real estate or alternative investments in general. We also got some celebrity guest speakers coming in, like Emmitt Smith. Obviously us being based in Texas, right? Having Emmitt Smith from the Dallas Cowboys, who is an NFL Hall of Famer, is really unique to have him come in and really talk about it, about just investing in general. One thing I do like, though, besides the expo, is we keep getting closer and closer to the next tax deadline being in October. For those of you guys out there that are still waiting, come on, don't wait. Get those contributions in. Get those IRA set up so you can contribute for the previous year and some of those things like a SEP IRA or maybe an old solo 401k or something along those lines. And let us know what questions you have. As we also go through this entire presentation, we have a couple of different moderators that can answer your questions, but I want all of you to leverage that chat box. Notice in the chat box, you'll see things, right, that like pop up indirectly, such as links to the Quest Expo, links to other events. But you can also use this to actually network with one another. You can use it to pitch deals to each other. Hey, I'm a wholesaler. Hey, I'm a lender. Hey, I got money. I need to know what to do with it. Right, I got a house under contract, or I'm just a construction guy. Use the chat box to leverage and network with each individual. All right, so leverage that area and ultimately put your questions there for myself and the speaker. We're going to be doing a little Q&A right at the end of this. So without any further ado, I want to talk a little bit about our speaker that's going to be up and coming right now. Honestly, he's been in the real estate industry since about the late 1980s. Right, he did start off with him and his brother doing a lot of work in that area, from things from not only single-family homes and property managers, but now doing hedge funds and a lot of commercial real estate and multifamily type deals. Now, one of the things is because we are a Texas-based company, I think a lot of you feel like we bring in a lot of Texas individuals, but we wanted to find someone that really understood the market abroad. It's not just doing deals in Texas, but doing deals everywhere. Someone that could really educate you. And I know most of you guys are accredited. There's a handful of you guys that aren't accredited or you're trying to get to that point. So we really want to make sure that we can tackle everyone out there and make sure we get a lot of knowledge to you guys. So we spend a lot of time, energy, and effort. And I know he's never spoken on our platform before. So I hope you guys enjoy him coming on. But we have today Tom Hoban. Tom, how you doing?
Hey, awesome. Great, Derek. Thanks for having me.
Yeah, no worries. So Tom, I'm going to turn the floor over to yourself. If you, once again, guys out there, put your questions in the chat box. Me and Tom will get to every single question at the end of this. But Tom, the floor is all yours.
Sure. Thanks, Derek. And thanks for not scheduling me right after Emmitt Smith. I'm not sure I could stand up that tall. It's great to be with everybody. I do these fairly often. I come to this business with a heart for education and service to others. It's sort of baked into who I am and who my brother is as well. We've been business partners since the mid 80s when we started the first of our ventures. Let me introduce Jessica Disman, who set this up. She's going to be running our slide deck. There she is. Where are the cats today? Are they hiding somewhere, Jessica?
Yeah, he's not interested.
Yeah, okay. Great to see you this morning. Thanks for setting this up. And Jessica will be running through just kind of a slide deck that helps me cue up the conversation. But this is conversational. The way I understand we'll roll through this is 30, 45 minutes of educational material for you, and then we'll open it up to questions. And then of course we're available anytime afterwards. If people want to follow up and talk deeper. We're going to talk about core plus multifamily investing. But before I do, I'm going to get a little folksy on you. For my friends in Texas, howdy. I feel up here in the Pacific Northwest in my Puget Sound waterfront little hamlet 50 miles north of Seattle, like I'm a misplaced Texan sometimes up here. And I was reminded of that. Took my team down to a hunting lodge outside of San Antonio just a month ago. and just really just had a thoroughly good time and just loved the people and all that. So shout out to my friends from Texas, especially. I think it's good to understand my perspective, because I'm just one voice out here in a sea of many. Not really a pitch man of any kind. We started out in this business, my brother and I, growing up in a little mill town in the Pacific Northwest. We do business mostly in Western Washington and the Pacific Northwest today. So I grew up, bucking hay and working on commercial salmon fishing boats. And somewhere in there, I did a little construction and painted and cleaned apartments for a couple of landlords. Didn't come from money. My folks were great, fine folk, raised great kids, but that wasn't kind of we didn't have wealth. And so I was kind of always curious about these fellows that owned the apartment buildings that we were working on, or other forms of wealth, and had that in the back of my mind. I was able to get into college at Notre Dame back in the Midwest. I just kind of wanted to see what was east of Idaho, and applied to faraway places. And by the time I got out of there, I'd seen 46 of the 48 states and met a lot of interesting people and got a really good business degree. So I had this kind of combination of sort of blue collar, working with your hands background, and then this, sort of Wall Street oriented finance experience at Notre Dame. Came back to Seattle area, started out in banking for about 3 years, then went to work for a client in property management. And that's when the vision came to me to see that I could maybe combine those two sets of backgrounds and skill sets and interests, honed with a little bit of the banking and the finance, and maybe make a living at it. I was in that business only 6 months working for someone else, and I could feel that sort of squirrely sense that a lot of us who are entrepreneurs have, and broke out and signed our first contract for $1,200 a month on a 29-unit apartment building in a little town called Everett, north of Seattle. And that's the start. About 1987, my brother finished up also at Notre Dame and was a free agent. So I grabbed him and off we went. We've been 50-50 partners, Sean and I, ever since. So that's 35-ish years ago. So been through the S&L crisis, been, through the dot-com crash, been through the 2008 debacle, even uniquely impacted because we're an aerospace community out here in parts by the use of airplanes in the 9/11 attacks that really choked the airline industry. And then, of course, most recently, the pandemic. So, pretty grizzled veteran, and been there, done that, been through the good times, the bad times, and all that from a property management platform that today, with our junior partners that run it day to day now, manages about $8 billion in apartment buildings, office buildings, malls, shopping centers, strip centers, self-storage, even at times some condominium associations. So I think at one point, about halfway through, Jessica, I never told you this, we managed a horse ranch. So there you go. If it had a fee, we would manage it. So that's my background. Again, not coming from kind of a capital markets background, we learned the ropes as operators. And that's what informed us when we were in a position to finally invest and maybe get into the game ourselves, probably 15 years ago, when we formed what was the beginning of Coast Equity Partners, CEP Multifamily, we call it today. Grabbed a couple other fine folk and off we went. When the crash hit, we got together and had the vision for workforce housing. And we did that a couple ways. There were some opportunities coming out of banks, of course, that you all know about. But we also just wanted to chase the lowest risk, most reliable yield story we could find. So if you learn nothing from this experience with me today, low risk, yield oriented, long-term success is really what we sought when we found our way to core plus multifamily housing. And we did that by taking random 7 to 10 year slices, looking back into the marketplace and the portfolio we directly managed in all product types. And while there were certainly some good times when, a single tenant triple net lease somewhere, or, a single tenant industrial property or office buildings were having their way, if you did these random 10-year slices and you look for consistency of returns and yield, Core Plus multifamily housing just jumped out at us, and it needed to be probably more than 100 units, fully amenitized. And then what was helpful for us from that operator's background was looking at the ecosystem around it and having a deep understanding of the customer. So later, you'll see a slide that will tee up management alpha, and we're going to talk a little bit about it then and what we learned from that. I can't tell you all my secret sauce, or it'll become somebody else's. That's the closest thing to IP I have, but I will give you some highlights to appreciate how, as we say in the business, the grind is the alpha. The grind is the alpha, and the grind for us is managing with this vertically integrated operation we have, the day-to-day operations, knowing our customer and figuring out what it is that drives results there. So that's pretty good, maybe a little long-winded start to it. So maybe, Jessica, if you can advance to our first slide. I think I've done a decent job of introducing myself and our background. So, you know, why invest in commercial real estate? You know, we have a whole bunch of folks that have self-directed IRAs with us, and the long-term nature of those and the long-term nature of our assets tend to be a really good match. And so we've been sought out by folks that advise people with those to make these sort of presentations and invite them in. And so why commercial real estate? Because you have a lot of different options where you can direct that. Well, the first for us is the portfolio diversification and risk mitigation. We note there the low correlation to the stock market volatility, which we've talked about for a long time. We always do. And boy, isn't that important today, right? As we've seen so much volatility over there. And here we are over in our commercial real estate category, multifamily housing, just chugging right along like nothing's changed. High yields, you know, that's all relative, right? But we do produce consistent, reliable cash flow through the life of the investment. So anybody that's rented an apartment or owns small rentals or is a partner in multifamily knows that it's a simple business, right? We provide shelter for people who need a place to live every night. And we do that on a large scale. And as long as they pay rent every month and we collect it and we don't overspend to deliver a good product to them and make the experience strong for them, there's a profit every month. And so that consistent yield is important. And that's where that management alpha and sort of the grind, as we call it, comes to play. Appreciation, you know, we sort of, I don't know if it's slang or not, but we sort of say we're like a bond with a kicker, and the kicker is the appreciation, right? So in our case, particularly out here in the Pacific Northwest, where we have a row of mountains running north and south on one side that limit growth and restrict housing and expansion, and on the other side we have a strip of sort of to compare it to Texas, sort of an intercoastal waterway, if you know how we're set up with the Puget Sound that limits growth on that side. So we have this ribbon, Interstate 5, that runs north and south. And on 5 miles either side of that is pretty much the bulk of our population. And so in that supply constrained environment, you look out west and you wouldn't see imagine that we're very dense, but actually in many ways we are. And so we're very supply constrained. We've got to worry about fish and streams and tribal interests and mountains and water rights and all kinds of things as we develop. So it's very difficult to assemble, 11 to 15 acres and build, a garden style apartment building across the street from the one we own. And so we like that. And that's very often where the appreciation comes from. It's because of a supply constrained environment, which we'll talk about a little bit later. Tax shelter. Everybody knows what the tax benefits are on the, with depreciation, these sorts of things, and those are direct. In fact, most of the K1s that we send out in the first year or two of ownership of an asset, and this would be typical of anybody in our space, show paper loss for maybe at least the first year for sure, if we use cost segregation and accelerated depreciation, all the depreciation tools available to us. That seem to, from a regulatory standpoint, IRS standpoint, seem to be consistently protected over and over again. And then if you're fortunate enough to be in an opportunity zone, and sometimes those are, in urban areas where we maybe aren't interested in being, but you can still find them in other places. There's some other tax benefits. And even in some municipalities, you'll see some property tax abatement or deferral, or even just full relief. So there are plenty of tax benefits worth exploring. We know them all. We're pretty aggressive about going after the ones that we can. One reason we've liked Washington State, and I'm going to bounce right up to the edge. I promised Jessica I wouldn't get too far out there, but it's a little bit of we're kind of a political anomaly out here in this state of Washington. We look a certain way, but one thing we don't have is a personal income tax. And you might say, well, how does a state like Washington, surrounded by income tax states, Oregon's is 7-8%. Everybody knows California's is very high. It's in the low teens in some places, depending on your city. And we have zero out here. So one reason we're drawn to the Pacific Northwest in our market is, and other markets that maybe mimic it, is that in our case, no income tax is baked into our Constitution. Just about impossible. They try a lot, but impossible to break through. So the built-in tax shelters that are there from the IRS and other means are everywhere. And particularly one reason we're drawn to our state is because of the no income tax here. Okay, Jessica, let's go to our next one. There we go. So why multifamily? Commercial real estate, as we know, is a big category, and I don't mean to insult anybody, but just to be clear, commercial real estate is kind of a broad category. Sometimes you hear us call it CRE. That could be anything from an industrial building to a mall to an apartment building to an office tower, anything that puts a roof over people, whether they're sleeping there at night or they're working there by day. That's considered commercial real estate, particularly if it generates income. So you see the four major categories there. We've chosen multifamily, again, informed by this idea that when we did these random 7 to 10 year slices looking back, and then we projected that forward, no category consistently delivered yield over time better than that. And we believe that's, well, we know at some level it's rather obvious. Everybody needs a place to sleep at night. So the old example we used to use is pretty dated now, but in retail, I had a retail center when we were that we managed that had a Blockbuster as its anchor. Well, you know what happened to that one? Technology just changed that, and that business went out of business. So the office towers are struggling right now, especially in the urban centers. In most major cities, occupancy is only back to between 60 and 80%, depending on your city. And so there's some questions about, where office rates will be when these leases keep rolling over post-pandemic, if we can't get people, desiring to come back into the offices, no matter how hard the employers try to make that happen. It seems like it's a little challenging. And then industrial has done really well through the pandemic and since. So, the four big reasons why multifamily stands out: demand, it's a basic human need, as I mentioned; diversification. This is an interesting one. We learned the hard way watching, from our front row seat managing property for other folk, just how much exposure you have if you don't spread your revenue out over multiple tenants. So, we have a rule of thumb that we wouldn't want to own anything where there's a single tenant that exceeds 20% of the revenue on an asset. That would be sort of a have to, even if we stepped outside of multifamily. But in the case of multifamily, you're really working on sort of an aggregate number, right? 5% is kind of a average sort of healthy equilibrium vacancy rate. And, on a 200 unit building, you might be turning anywhere from 5 to 10 units a month, and so you're just in that churn mode trying to reduce turnover. And but spreading that risk out over multiple tenants is a big deal. Flexibility, office leases, retail leases, industrial leases tend to kind of run in long terms, 5 years with options, that kind of thing. So you don't really have the ability to adjust and make moves quickly. We can. Our leases tend to run 1 year in length, and they tend to stagger. So if the market moves on us, as it has in the last 6-8 months, especially, we can react to that. Plus, we have turnover, and so every time a unit turns, we have a chance to re-up the rent there. So a lot of flexibility, quicker response. We can also make moves, if things soften too. We can make quick moves and shore things up quicker and delay the impact of a downsliding market. Although, at least in our case, we've been blessed out here to really never go backwards in rent. We've had only a couple years in the last 20 that have been flat. When we underwrite a deal, we underwrite it to a 4.8% annual rent increase based on historical averages and what we expect it to do over a 7 to 10 year hold. And we've pretty much hit or exceeded that in all of our acquisitions over the last 15 years. So speaks to that flexibility. Enhanced tax benefits, we talked about those a little bit, but it's a great shelter for a bunch of reasons. Okay, Jessica, you want to roll to the next one? Let's see, short-term real estate investing, sort of this value add or opportunistic strategy. I think, for, wearing our educator hats here for a little bit, it's important to understand not only what the broad categories of real estate are, but once you sort of find a category, there are many ways to play ball. We were looking when we made our moves to, low risk, consistent yield with that appreciation kicker. And we've talked a little bit about why that happens in multifamily and in the core plus sort of suburban markets with supply constrained elements. But lots of people, in fact, most people I meet who haven't done a lot of real estate investing assume that I'm a developer, or that somehow or another I'm buying real estate and doing flips and that kind of thing, because that's what they hear about the most. So short-term real estate investing would kind of fall into those two categories, well, maybe three. You could be a developer, of course. That's that opportunistic, where you're speculative, ground-up construction, doing land development, that sort of thing. Different risk structures, different moving parts, a lot of stuff to talk about there, but that's we sort of consider development kind of an opportunistic strategy. And then value add. So this is kind of an inside baseball term for, buying an apartment building, seeing that it has the potential to increase rents, but it needs some fixing up, right? So you buy it, you put, $10,000, $20,000 per unit into new kitchens and carpets and clean it up, and maybe you paint the building and you add a new gym to it and do some things in the common areas and clean up the outside, and you can charge a little more in rent. There's a wide range of risks and stories there. In some cases, people will come in and completely vacate all the units, do all the work, and then try to re-rent them. That's a risk story that's maybe a little different than those who buy the building, and then as these units naturally turn over. And it might surprise you to know that the average turnover rate across the nation, pretty consistently, outside of some of the rent control markets, is about 60% a year. So imagine that, a 200 unit apartment building over the course of the year, 120 of those units will have different people living in them a year from now. So there's quite a bit of turn and churn. Well, that natural turn can be an opportunity too if you're doing a value add where you come in, fix a unit up. You're going to do some of that anyway, right? That's the paint, clean, spit polish it up, get it ready for the next tenant. But a value add would be someone who came in and actually, traded out the carpets and cabinets and did some big stuff, and then moved rents in a significant amount. They both have, great potential for cash flow and appreciation. In the value add category, we typically see that transition taking about a year to maybe 3 at the most before all the units have been touched and scrubbed in one form or another, and then those new rents stabilized. We've done a few of those ourselves and had great success with them, but they do have a risk period. They tend not to generate a lot of cash flow during that transition period after acquisition and on your way to the new rents. So that's the downside, is there's a period of time where there's probably no cash flow. There is construction risk. I mean, anytime you bring in a crew, you've got, and today it's, everybody knows about it, supply chain problems, labor problems, all kinds of things that go on the construction side that make it tough to pin down costs. And then, people can just make mistakes and not flash the windows the right way. And all of a sudden you're going backwards on your plan. Capitalizing using short-term debt. There's a little bit of interest rate risk in there because we're usually capitalizing these with kind of a construction loan product on the acquisition side, and then we put a perm loan on them. So So really, Jessica notes it well in the slide here. The successful exit of a opportunistic or a value add deal really depends on where things are about a year to maybe 3 years from now. And you can imagine with the interest rate increases right now and these supply chain issues and maybe a little labor challenge that contractors are dealing with. Right now, every value add deal and every development deal or opportunistic deal is being scrubbed very, very carefully and looked at very hard. Okay, Jessica, let's keep moving. There we go. All right, so try not to be too solicitous here, but this speaks right to sort of our sweet spot, and I think where Derek would like me to spend some time with you, and probably where we'll spend most of our Q&A at the end. But this long-term real estate investing is very different. I describe it as buying a bond with a kicker more than it is anything else in real estate, like the opportunistic or value add. We kind of divide this up into a couple geographic sort of stories, to put it simply, core and core plus. So you see the bullets under core. That's kind of existing income-producing property. You don't need to make any big physical improvements. It's basically been built and seasoned. It's up. It's generating cash flow. And as long as you don't overpay for it, you can bring your management alpha, to bat and try to find some lift, typically in trying to tap that annual turnover rate down a little bit by serving the customer differently and looking for some things that could be done there. Hold periods tend to be, kind of 10-ish years on the core. Core plus, just slightly different. It's still all apartment buildings. It's existing income producing properties. Again, little no renovation required. It might be underperforming a little bit more. It might be in a suburban or a secondary market. It's got the cash flow and then maybe a little more opportunity for appreciation. And again, we hold those kind of 5 to 10 years or 5 to maybe 8 years. Depending on how well they perform. That's been our average. Actually, we've hit our 10-year return expectations on average between 5 and 8 years in our portfolio. Again, that management alpha and that daily grind tend to get us there a little quicker. We don't tend to time our markets either. We're not really in that game. If you do those 10-year slices looking back and looking forward, you can get those consistent returns that we're chasing. That serve our IRA investors and others quite well, no matter where in the cycle you buy, as long as you don't significantly overpay at the front end. So anyway, the punchline there, of course, longer term investment opportunity provides consistency through multiple market cycles. That's the point, right? And we're a great hedge against inflation. In fact, right now, as things get a little wonky out there and inflation hits, we can move our rents along with the wage increases and the other things that are happening. So it's a great protection there. We are a fund right now where we have a $50 million fund that Derek might ask about just because everybody is sort of aware of it. We're talking very openly about how we're a hedge against inflation, and we haven't had to do that for a while, but we have to remind people about that when we're out telling our story. We're structured in a way where, we don't have a fixed date where we have to exit. So that's important to look for, whether you're doing business with us or somebody else. I think having a back end that isn't tied to a date gives the promoter and the manager an opportunity to exit at the right time. Long-term debt is important. It's hard to get these agency loans, Fannie and Freddie and some of the others. But they are competitively priced, and they do help generate that early yield. So in our case, as would be the case, I would think in anybody you'd be interested in, we're sending out dividend checks in the first full quarter. We own the asset. A lot of the reason we do that is we get positive leverage from that appealing interest rate that we can get because of our scale and size. Okay, let's see, Jess, how are we doing here? Should we go to the next one? Yeah. So all right. So this gets into the inside baseball stuff a bit, and I'm happy. We're at CEP Multifamily. We're really open book. So up to maybe a couple little detail points in our underwriting that I like to protect. But gosh, in the Q&A, if you want to go granular, I'm happy to. For what it's worth, I walked inside a CHOP every day when that was going on. We had the properties we managed there, And I can talk to you about some of the properties we own way out in the country and all the different experiences we had. So happy to share that insight. All right. Well, so how do you buy right? Well, first of all, you got to earn yourself into a position where you're competing for these deals. And we didn't talk about it here, but access is really challenging. Once you've earned, you've treated brokers and sellers and lenders and the marketplace well through some transactions, you sort of earn the right to get into the best and final rounds for most of the assets you want to acquire. And we've already identified the 60 or 70 that we want to own that meet most of our characteristics, and talking to the sellers and their brokers, about those all the time, so that we're well positioned, when they come up for sale. But you get there by behaving well in the marketplace and having a reputation of, showing up on time, with the money to buy the deal. So that's important to understand in terms of, because you could do all the insights from a professional slide stuff here to mark up what a great purchase looks like and never get to the dance. And it took a while for us to earn that spot. We're excited to be there, but it does start with a good purchase. It's impossible to buy back a market very often. We've done it recently on this current fund, where we deployed very quickly the money we raised in the first month on 2 deals that we speculated on with the developers, that they would finish the assets and deliver at a rent number we thought they could achieve. But at the time, a year or so ago, when we came to terms with them, they weren't so sure. I think the pandemic had them a little more worried. So in these cases, we did buy these, in one case, $6 million back of appraised value at purchase, and the other one about $900,000. But that's pretty rare. And that was probably a moment in time with the pandemic at play and us having some, maybe better understanding of the, day-to-day experience of actually managing and delivering rents on these things. But it does start with a good purchase. So at least for us, we are really linked to the idea of supply-constrained environments. So, and I talked about the mountains and the water here, but there are other markets that have that too. We maybe have also a political climate that's a little more anti-growth in some places, and so that also can inhibit growth. We have a term in the business called NIMBY, not in my backyard, and it's a cultural problem across the country. Where once people sort of buy a single family home or something in a community, the last thing they want to do is have a bunch of apartments pop up around them, and that tends to kind of create a political environment at the local level that restrains growth. Those growth management regulations are part of it, but the cultural elements and the local politics have an element too. In our case, we have a Growth Management Act. So imagine a state that's so laden with growth, in the state of Washington, at least over the last 20 years, that we need to have a law to manage the growth, where many states are trying to figure out how to stop losing residents and just retain what they have. We have the opposite problem, and it continues. It's still we've net gained people during the pandemic, and even in spite of some of the negative news out of the city of Seattle, the rest of the state's doing just fine, thank you, and we've done pretty well. But those regulations do limit supply, and so it's important to understand those. There can be other things that limit supply that aren't just about geography and politics and regs and NIMBYism. So we look to those, and we're looking at other markets all the time that present those. But we're most comfortable where there's supply constrained environments. And I think that's just good advice, something to look at whenever you're considering investing in real estate yourself. Put it this way: if you own a 150 unit apartment building sitting on 10 acres in a suburb of Houston, how much would it cost for somebody to assemble 11 acres kitty corner to you and then go through all the trouble to build and deliver that product across the street? And what rent rate would they have to charge to make that happen? More than likely, if you bought an existing building already up and going at today's price, whatever it would take 3 years from now, maybe 5 years from now, for someone to assemble that competing property across the street would probably come in at 10 to 30% higher rents than yours. At least that's the case in our market. So in a strange sort of way, not only are we protected on the supply side, and it's something I really can't emphasize enough. I'm staying on this subject for a long time for a reason. that supply constrained environments create an environment where you're almost welcoming competition across the street. As long as your product isn't physically inferior, someone wants to come across the street and build something and charge 15% higher rents and pull all those people in the neighborhood. And while they're in the neighborhood looking at that, they can jump across the street and enjoy that same neighborhood and the schools and the grocery and whatever it is that draws them in there. Walkability, go down the list, and do that at 15% cheaper with me. I'll take that all day. Understand current market conditions. So, we have to be skilled at negotiating. We have what we call today cap gap. It's happening right in front of us now. So this is where sellers' ideas of value were based on really today and yesterday's realities. And in environments like this where interest rates are moving up, buyers are looking very far forward. And so it takes a little time for buyers and sellers to believe in the new realities. Buyers want to believe that, and point to interest rates and inflation and other things and say, well, the future looks pretty rough. I'm only going to offer you this. And sellers say, well, I don't believe that yet. So cap gap is actually an opportunity if you can manage your way in your negotiations the right way. But it is a reality of expectations between sellers and buyers that has to be understood. We never want to underestimate operating expenses. I don't know how to say this a nice way. If any of our broker friends are on the horn, but you really have to take the broker's package and kind of toss it away and dig in at a granular level, which we have had some advantages doing because of our operator background. And really rebuild the P&L for this little business, this community you're going to buy from the ground up. And underneath that, you can find some efficiencies that maybe you can bring that the seller wasn't able to deliver. But either way, you've got to build a new P&L from kind of the ground up based on today's realities. All right, this gets to the fun stuff. Know your target tenant. One of the, I don't know what it is, but when I travel and I talk to large groups and I speak about, multifamily, I'll run into somebody that's in commercial or industrial, and they almost kind of have they almost kind of look down on me. And I don't mean that I don't mean that the wrong way. I mean that respectfully, but they kind of look at me kind of like, who could possibly want to be involved in managing apartment buildings as a means to make a living? And I'm sure there are days when Deshaun and I have wondered that ourselves, but for whatever reason, it could be the way we grew up humbly and in a blue collar kind of mill town ourselves and worked with our hands and stuff, but we get it. We get it. People making, 40 to 85 grand a year that need a good place to live. They deserve as much dignity in this life as any of us. And so there's something sort of joyful that we get out of the hard work of managing an apartment building. Sure, we spend 90% of our time on the 10% of people that are, causing trouble, making noise, not parking in the right place. Their kids won't, park their bikes in the right spot. They put junk out on their deck and all the stuff that goes with it. I get it. But the 90% of folks that wake up every day and just want a safe, clean, affordable place to live and call home, the silent majority, we call them, are just a joy to serve. So, where do they work? Is it limited to one employer? Obviously, we can translate that same experience we had in retail and some other categories where we had a high concentration of revenue from one particular tenant. That can happen in multifamily if a large slice of your tenancy, and we actually limit that to 15% in our underwriting. So there's one of our inside baseball details. We will not buy a deal if one employer represents more than 15% of the employment base for the tenants in the building. We just think that's too much exposure, and we've been burned by that in the past. The 9/11 story I told you in my intro is a good one where we owned a building near one of the Boeing plants and had about a 30% concentration of Boeing employees there. And when airplanes were used to hit the towers in the Pentagon, and then the one that crashed in Pennsylvania, people stopped flying. So most of these buyers of airplane deals from Boeing have carve outs for war and hurricanes and whatever. And they were able to point to those little carve outs and cancel their contracts. And, a good 20% of our tenants moved home to Oklahoma, where they came from, and waited it out, and we didn't have anybody to replace it with. So lessons learned there. What's important? What does the immediate neighborhood have in it? I'm just going to say, because you live somewhere and you've rented apartments and you've got kids that are renting apartments, and we're in this world all the time. This is not rocket science. Everybody knows how to be a consumer of apartments. Obviously, schools, grocery, public transportation are important. I'll just say that for us, wise investing in this space has placed an extra emphasis on that ecosystem around, and a recognition that our customer is usually a woman. Maybe 70-80% of the time, even if there's a spouse or a significant other involved, the decision of ultimately where to choose to rent will be made largely by women. And so what's important to them is really our whole business. There's a reason why 68% of our employees are women, and we want to deliver a value proposition to them that works. And that's not to get all gender oriented or whatever, people might react to there. That's just the reality I live in. That doesn't speak to other issues. It's just, that's my customer. Safety is important. Cleanliness is important. Proximity to the schools. Even long before all the political stuff for the last year or two, we were placing way more emphasis on the makeup of school boards than we would have ever cared about the city council or the mayor or any of those other things in the cities where we are, because school boards are a reflection of the values of a community and tell you about where people, how much they care about children. Well, more than half of our residents are, between the ages of 25 and 35 and have kids. And most of those are in elementary school or middle school. So of course that's important to us because it's important to them. So understanding our customer is critical. I could spend 2 hours. I'm not going to touch more than I have, but I could spend 2 hours just talking about how we underwrite to that unique ecosystem on our way to figuring out which 60 to 70 buildings in Western Washington and a few other markets that are supply constrained we would even have an interest in owning. It has a lot to do with those sorts of things. Okay, Jessica, we're getting close to the end here, I think, and want to talk a little bit about management alpha. So, it's kind of a fancy term for, what's our secret sauce or how do we bring any value? Well, we're not developers. We're not builders, we're not, we don't bring any particularly unique financial leverage to the game other than being able to secure agency debt and underwrite smart. Our upside, our alpha is on the grind and the management upside. So, we're, as we sort of say, we're kind of grinding these for cash by over-serving the tenants. So you'd be renting an apartment that would be kind of called a Class B or B plus apartment, but we want to give you an A experience. And that's where sort of the lift is. So how do you do that? A bunch of ways. And we talked about the underwriting. That's a big part of it. And then the day-to-day management might be have some, unique ways that we go about doing the work and communicate with our residents. The goal is to maximize value and cash flow, right? So we're trying to drive those consistent high revenue sources that we can. We do some things with the utility billing that are noted there. We'll take a look at the light renovations and always an eye on rent growth. But rent growth itself is not always as easy a lift as just over-serving the residents and trying to reduce that turnover. So reduced turnover is really the best place to secure lift. We're working on occupancy all the time. 100% would be great. It's physically impossible because you still got to have a few days in between tenants to, clean and paint and get things ready for them. But anything, above 95% is considered kind of tilting to the landlord's favor. We kind of average around 97.5%. So that's key. And as I noted, reducing turnover is essential. Okay, Jessica, is there another slide? I can't remember where we are here.
No.
Oh yeah, just that's the guy there, I guess.
Who's that?
Yeah, right, exactly. So you've heard way too much from me, folks. Eager to answer questions. I'll kick it back maybe to you, Derek, and let you run the show.
Sounds good. So this was really good. This was actually really great. But I'm going to remove your information up here. Everyone, real quick, take his phone number down, and then we're going to pop it back up here in just a second. But 425-551 0802. And Colin, if you could put that in the chat box and then post it up top, that'd be awesome. So, Tom, a couple questions for you. And Jessica, you as well, feel free to chime in because I got some things from clients, and then we're going to get to all the questions that you guys posted down below here in just a minute. But the first thing is, honestly, right now, I know you guys aren't builders, but one of the biggest problems I think a lot of our investors have and a lot of our clients have is sometimes when someone like yourself, they come on and you're used to raising capital, you're used to doing investments, but man, you've gotten so good at it and you've gotten such a big following and you have clients that are so happy with you. Sometimes you open up a new market and you're like, hey, I'm raising capital right now, and boom, it's filled up in a day or two. And that's not an exaggeration. I know that recently happened with you guys. So if someone has some capital and they're looking to invest, are they able to invest with you guys right now?
Yeah, well, I'll take that, Jess. Yes. Your timing was great when we met you. And thanks again, Jessica, for making that happen. We have a $50 million fund we're doing right now. I mentioned maybe at the beginning, we sold about 31 million of it within the first 6 weeks or so. We've been in business. Yeah, I've been in business for 15 years. I mean, I have more people interested in our program than we have seats even at that fund level. We do have a little sleeve that we reserve for Black investors. It's something we've been involved in for years and years, trying to narrow the wealth gap there. Through all kinds of strategies and means, but still a lot of room, and timing's great. We have a lot of people kind of waving their hand, waiting for us to get through our existing stable of investors, and we're kind of getting near the end of that. So timing's pretty good.
I love it. I love it. So then the next thing is a couple things is sometimes people will wait to pay dividends. And sometimes people pay dividends immediately within the first month or first quarter. Now, I believe you guys pay dividends within the first quarter. Is that correct?
Yeah. We're in these things ourselves. So for what it's worth, we've got a lot of skin in this. Is our game. And we just made room for other people to jump on the boat with us is all. So we'll have anywhere from 5 to sometimes 20% in each of the deals we bought over the years. We've done direct invest in the past, kind of one at a time, buy a couple, 2 or 3 a year. And this year, of course, this fund will probably own 4 or 5 deals altogether. It's got 2 in it already that are have some captured equity from buying back a market a little bit. So yeah, that's the experience. It's a yield story. I don't know how you could be in the yield business and not distribute cash quickly, but because we're buying existing assets that already produce cash flow. Yes, first full quarter we own it. You get a dividend check along with your report, and then every quarter after that. We've never missed a quarter, so we've always been able to distribute. We did
never missed a quarter. How long have you been doing this?
Yeah, about 14, 15 years. Full disclosure, though, and because people probably will ask, I'll just be brief on this, but you can't talk about this business and run past the pandemic, right? Just about every state had eviction moratoriums and restrictions on rent increases and all kinds of other stuff. So we did hold. We suspended some of our distributions at the request, at our own judgment, and at the request of a lot of our clients who, in their thoughtfulness at the beginning of the pandemic, said, "Don't send me a check. Keep the money there just in case these folks that live in our building, need help." And thankfully, that early PPE package and the great save there, kept people from running out and rioting in the street and bailing out on us, and we held it together. We only had a small delinquency amount. We're kind of finishing the last of them. So the pandemic was rough, and now we're playing catch up on the rents that were flat for 2 years and getting.
I mean, I think it's that way across the board. It doesn't matter whether you're thinking single family or store. And everyone gets that. 2020 was interesting.
Yep. So we made up for those, but yeah, we did suspend them for a little while just to wait and see what happened. It worked out.
Now, I feel like this question's more for me, and so I can tackle it if you want. But debt leverage real estate investing using a retirement account, right? When they fund into any type of hedge fund or multifamily deal, it brings on some additional taxes. Now, do you want to comment on this, or do you want me to tackle this question?
No, go ahead. Yeah.
Yeah. So, guys, when you see this thing, what our client here is talking about is something labeled as UDFI, or unrelated debt finance income tax. Most of you out there will think of this as UBIT, right? Or unrelated business income tax. Now, here's the thing is I like to describe UBIT, and I'm a nerd, I really am, but I describe it as Star Wars, right? So if I'm like, hey, do you like Star Wars? Well, that's very broad. Are we talking about the toys, the Legos, the movies, the prequels, what are you talking about when you say Star Wars? Well, that's UBIT. UDFI is a very small subdivision of it. So it's like if I'm saying maybe a specific character, like Darth Vader, well, that's UDFI, and that's what these investments bring on. What this allows your IRA to do, though, is take all the same deductions an regular individual would be allowed to take to offset any taxation the IRA would incur. On average, if I see someone invest $100,000 over a 5-year time frame, by the end of the 5 years, the amount of taxes they owe is usually $1,000 or less, right? And that's assuming they doubled their profit. They invested 100, they made 100 in profit. Like, guys, come on. So if that's what you're worried about, understand that you're just not educated in the area. So I do love this question, but don't be afraid of, oh, well, I owe taxes. Man, you owe taxes because you made a whole bunch of money. Congratulations. A couple of the questions we have is how apartment deals will impact and increase interest rates environment, both short and long term.
Yeah, great question. That's upon us right now, right? The pricing we're getting on loans. It's funny though, the cap rates is another discussion point sometimes, because they tend in the past to kind of travel with interest rates, although it's interesting, they haven't quite correlated the same way. So interest rates are just, a higher cost of funds for us. So in this cap gap environment, we've got to convince sellers that, our new reality is their reality. And, if somebody wants to come in and overpay for something, they're welcome to. So a lot of it just translates back to discipline. You just have to say discipline. The God we serve, if I may, is that yield number. We're fighting for that yield number. If we can't see it real clearly on the way in, no matter where the interest rates are, then we simply just won't do a deal. At least in our case, we get at bats at enough deals where we don't have to do a deal. And maybe that's a luxury we've earned over the years. It's an issue. It's an issue. And, of course, the first thing we all talk about when we get on the horn with each other is, where are interest rates going to be in, 6 months? What's the Fed going to do? All that stuff. The good news is I've been through this kind of thing a bunch of times. So I will say that maybe experience has caused me to maybe panic a little less and understand the context of it. So that helps.
Yeah, so a couple other questions here that just for my general knowledge, this wasn't from any specific client, but I get this question a lot from my clients, is lately, right, there's a lot of syndications out there, a lot of hedge funds where people are raising capital for some form of multifamily. So for you as an individual with this, do you guys have an extra advantage over some of those other syndicators or some of those other people? And I think I know what the answer is, but I'm just kind of curious.
Yeah, I mean, of course we think we do. In our case, we have that management alpha from being vertically integrated and growing up inside of property management. I mean, it'd be hard to find anybody who promotes real estate deals that has a deeper background in managing really all kinds of assets, but especially apartment buildings in the Pacific Northwest. I think we have kind of got lucky too. We have this supply constrained environment around us in a state that has no income tax and it's protected in the Constitution. So we probably have some background advantages there. And then the last would be, and you want to pay attention to this no matter where you're investing, is, does the promoter have some unique access to the market, some unique insights so they can, that you can be convinced that they can access lots of deals and they don't have to do a deal. I think that would be an advantage for us. We really get to kind of play ball with lots of opportunities and pick the ones that we really like and go after them. And, we'll get into the best and final rounds. It's competitive to buy these deals, even, against the other firms like ours that, have access. But if we're in the best and final round on, 3 or 4 or 5 deals, we're going to get one of them. And that's kind of how we play it, access.
Now, I see a couple other questions here real fast. I'm going to briefly talk about this one. I don't want to dive too much in it. It said, Derek, I heard that you can be exempt from UDFI if you spend less than 100 hours managing your asset. Guys, remember when you're using a retirement account, you really shouldn't be managing your asset directly anyways. Now, there are other ways to get exemptions from this, leveraging things like a solo 401k or a QRP plan. But I'm actually going to be talking about a class on that on Tuesday. So if you want to dive more into that, just let me know and we can go ahead and go through those motions. But I love these type of questions. Keep bringing them on. Now, real fast, I was going to just, on the comment you just made about, some of those advantages, I think one of your guys' big advantages, though, is just your time and service. Like you said, when things go wrong, you don't panic. I think unfortunately a lot of our clients, they meet the brand new guy. This is first time doing a multifamily deal, first time raising capital.
Yeah.
And nothing against you all out there doing that, right? You need to start somewhere. But do you want to bet on the horse that's been doing it for how long? 15 years?
Well, investing for 15, but managing for 35. So,
There you go.
we're so risk averse. I mean, if you saw the way we live our lives, somebody once called us the boring husband fund. So, that's,
I like
that low risk profile is baked into everything we do. We worked so hard to get any shekels put together initially that the last thing we want to do is blow it. So that's part of it. I would say to folks looking at this category, especially if multifamily is interesting and they're looking at other promoters and opportunities, Derek, I'd also want to make sure that the promoter has skin in the deal. Yeah, you need experience. Now you need access. You got to have some kind of an alpha of some kind. You got to have all the bones, and there are plenty of us out there. But just make sure they've got real skin in the deal. In our case, we do. This is actually how we invest, and we just let others come along with us. And it turned out to be a good formula, so a lot of others won.
Well, Tom, this has been really great. I do appreciate you coming on. Any last minute and anything to close it out real quick before I close it out with some final statements?
No, just appreciate the chance to talk to people. Really, it's a blessing to be in this business and be able to serve others through it. So we're just, I'm just excited that you let us come on and talk to your folks. Thanks, Derek.
Absolutely. Well, guys, real quick. So we actually have one of our newest sales reps. He's the one moderating. He's the one that keeps posting all the stuff that you see come up there on the thing. His name's Colin. So don't email me. Email Colin, colin.taylor. But because he is brand new, if you do need to set up a brand new self-directed IRA and you're interested in investing here with Tom, right? Or, I mean, it doesn't really necessarily matter what, but he will be able to waive your fee for the rest of this weekend. So it's typically $100 to set up an IRA, but call in, email him right now, and he will get you an IRA set up 100% free on Quest, on Tom and Jessica. So, guys, thank you so much for coming in. I really do hope we get to see you guys down at our expo coming up in September. If you guys aren't coming, let me know, and I'll get you a ticket to it, okay? So thank you, everyone, for joining. I hope you did enjoy this. And Tom, Jessica, thanks for spending your Saturday with us here, and I hope you guys have a great weekend.
Thank you.